we are currently, and I know people who've been to our workshops and heard us talk about it, we are in historically low levels of taxes today. We truly are, folks. I know it's hard to believe, but it's a fact.
Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Well, hello, everybody, and welcome to another episode of Reynolds Draft. I'm Don Reynolds.
Hello, everybody. Corey Stope over here.
You all know us both by now. If you're listening to the show, we hope you are, and we hope you're getting value, because that's what we're trying to do, is bring value and education to you. So as everybody's aware, we got an election coming up. Things are a little bit off the rocker right now, so to speak, but we don't.
I know exactly what's going to happen in November.
Oh, well.
You don't know that? I know exactly what's going to happen.
How is that?
One of the parties is going to win president.
Of course they are, Corey. I should have known that was coming. Well, that's a true statement. That's for sure. So, well, you know, what we want to do is talk about, really, there's 4 potential changes that could affect all of us, depending on how the election goes. So, number one, and a lot of people may know this, but tax brackets. We are currently, and I know people who've been to our workshops and heard us talk about it, we are in historically low levels of taxes today. We truly are, folks. I know it's hard to believe, but it's a fact. And, that's based on the Trump tax cuts that have been in place for basically 7 years. And we have through the end of next year is how it's currently set up. That's the current law. And then what's going to happen under current law is that those will sunset at the end of next year. And then we're going to revert back to 2017 taxes. And believe me, that's not going to be fun for any of us. So, that's something that's coming. We just don't know exactly what it's going to look like. And so we think that, we have to take advantage of what we call opportunity that's here today. And what we mean by that is low taxes today. So if we're doing conversions, let's do it. Let's maximize brackets. Let's do what we can to help you take advantage of opportunities that, in our opinion, are here today. Yeah.
This legislative risk can bleed into deductions too within taxes, not just bracket changes, but how much are we able to deduct? Currently we've got a standard deduction that many of us perhaps use rather than itemized deductions. It's a quite high deduction. As just a quick example, what I'm talking about, if you make $100,000 in income, and let's say that the current tax law allows you to deduct $20,000, you're going to pay tax on $80,000 of income. Whereas if the legislative changes that and we go to a $10,000 deduction, again, in my example, making $100,000, take away $10,000, now you're taxed on $90,000 of income, $10,000 more. So again, deductions have a big play, not only tax brackets, but how much can we deduct, and if we take that standard deduction rather than itemizing.
Yep. I mean, like I said, there's a lot of changes. We just don't know what they're all going to look like. But, we're big proponents of tax forward planning. I mean, that's really how we built this company. And so, we're not going to stop doing that, because we think that's important, because we know the 2 biggest things that erode your retirement plan are taxes and inflation, period. So now, adjusting which assets are taxed. We've talked about this in our workshops too. This is what we call our 3-bucket philosophy, because we see a lot of people who are paying taxes on dollars that they're not using. Now, I understand you're going to need more income later in life. That's a given. So, but why not control your taxes today instead of letting your taxes control you? And we see a lot of people who are paying taxes on bucket 2, which is future income, but also bucket 3, legacy dollars. A lot of people have money that they haven't touched for 10 years or maybe longer, and they know based on their situation, they're never going to have to touch it. But yet they're maybe giving the IRS, between federal and state, 30% of their interest and dividend income. We don't think that's a smart thing to be doing. And again, it's your money, your taxes, so we respect it. But are you aware that there are things that you can do, I guess is where we're going with this, to help that? So you're not giving the IRS your dollars, because obviously they're going to accumulate much faster if they're staying in an account where you don't have to give the taxes to the IRS each year. So we think that's an important thing to be looking at and looking into and understanding it, I guess.
And one thing on that asset or on the taxation, again, not only on assets, but on income, you've heard us talk at great length about taxation of Social Security. Folks don't know maybe the history around that, but in 1984, under the Reagan administration, they made Social Security taxable as much as 50% of your annual benefit could be income taxable to you. Prior to that, it was 100% tax-free. And then under the Clinton administration in 1993, they upped it to 85%. That's where we're at today. We've been there since 1993. So are there some changes coming to that where they could, again, flex that one way or the other? Or as Don mentioned, different assets and how they're taxed, or different income sources in retirement off those assets. So again, the whole, wrapper around taxes is the key is take care of what you know at the current moment. And as Don mentioned at the earlier part of the show, we're in low levels of taxation. Before any legislative risks come and before any changes come, you might want to take, a value in that and take some steps to change and or undo what maybe has been done to you to prevent some of these risks coming in our future with taxation.
So here's one piece of legislation. Now, it hasn't passed yet, but who knows?
Oh, yeah.
And so it's about including the House to enact a new annual required distribution from qualified retirement accounts like ours and 401ks.
Mm-hmm.
This RMD would be applicable at any age and would be triggered when a saver's retirement assets reached a value above a congressionally mandated limit. So again, more control what we're talking about. And it requires savers above this cap to take 50% of the excess above the cap each year, whether they needed income or not, and pay taxes on that. In essence, ending the tax preferred status of those funds. Again, while it hasn't passed yet, it's something that Congress is considering. So I think in summation, what we want you to understand is that when they change the tax code structure, it could mean you access your assets under a different set of rules than when you saved them. And so, again, our attitude is we need to be proactive about this, folks. That's our opinion. And that's what we're here for, to answer the questions you have. So, give us a call at 651-773-3859. Again, that's 651-773-3859. We offer free discovery meetings, so we'll meet you in person, no cost, no obligation, to share the facts about this stuff. Make sure that, we look at your, if you will, puzzle, that's what we call it, and show you the path you're currently on and what it's going to look like long term. When we do that with most people, they aren't very happy. You can see it. No. And so then it's up to us to try to provide solutions to help you.
Yeah, and just understanding the current situation you're in and the source of money and how you saved it and the current rules and laws around the taxation of how you saved your money. And then fast forwarding to future years and then looking at some of these things, again, that we've talked about today that are proposed and what could that look like if some of these do pass and go into law, and how do we prevent or how do we prepare for that is a better word to use. And what can we do today to help undo maybe some things that in the future could get a little bit concerning to us, and or if some of these laws pass would be very instrumental, impactful on you in your retirement. So again, give us that call. We'd be happy to sit down, go through this in further detail, go through your situation for further detail, and explain the tax laws, rules, and codes, and again, what we think could be coming into our future as being proposed currently.
Yep. Well, thanks, folks. We'll look forward to seeing you all next time.
Have a great day, everyone.
Thank you.
Bye-bye.
Listen to more with Don Reynolds and Corey Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.